Thank you for joining me today to learn more about structured notes or market-linked investments. We're going to talk about both. Those two terms are not quite familiar to everybody out there. They're a little bit interchangeable, not quite, but mostly. And we're going to talk about some of the aspects of how they work and why they're important. Before I get there, I'm going to talk about the three things we do for clients. As I tell everybody, I do three things for my clients. We're their go-to advisor, we optimize their wealth, and we execute with service and integrity. Well, today is about optimizing your wealth. And one of the things I often say there is we utilize tools on a daily basis that many advisors have never seen and never heard of. In this case, this is one of those tools. And from a history standpoint, this is something that we think is becoming more and more prominent, and we've been using for many, many years, but it's not completely familiar. And that's not uncommon in the financial markets. If you think about mutual funds, they were actually developed back in the 20s, but really didn't become widely popularized until the 50s. Hedge funds were founded in the 50s and really weren't widely populated until the 90s. Private equity came out in the 80s. I'm not sure everybody still knows what that is. But structured notes, really in earnest, the modern iteration of them came out in the mid-90s. And so I got like 10 or 20 years to keep talking about them before people figure out what they really are. But that's why I want to make sure that we keep educating our clients on what the latest and greatest financial tools out there are. But let's get right into it. First of all, what is a structured investment or market-linked investment? I'll often use the two terms interchangeably. I hope people don't mind if I do that. They're an obligation to a firm. So you're going to give money to another entity, typically a large financial institution. And when I say large financial institution, I don't mean a local bank. I mean institutions that doesn't seem to matter what city you go to, they seem to have a branch there. People with their names on stadiums, those sorts of large financial institutions. And in return, instead of paying us back a set interest rate or interest, like we would expect on a CD or a savings account with the same institution, they pay us back based on how an index does, right? So a market index. And there are three main reasons why people might use these things. One is capital preservation. Don't lose my money, right? These things can offer some protection. Risk-managed growth. I want to keep growing, but I want to make sure that I'm doing it correctly. I don't want to take wild gambles to do so. And the last one is enhanced income. Bonds are great, but can we do a little bit better? Can we do something that's different and not quite as correlated with interest rates? So there are five key pieces that kind of combine all structured notes or market-linked investments. One is there's two main types. One we call market-linked CDs, right? And those are FDIC insured. And I think most familiar with FDIC insurance, but it's backing by the federal government that you're not going to lose money up to obviously the protections at the time. 95% of the time when we talk about structured notes, we're talking about market-linked notes, and they don't have FDIC protection. So if there is FDIC protection, it'll absolutely be mentioned. But typically, it's backed by the issuer. So again, you're lending money to that issue for that set period of time. You want to make sure they're around whenever that time is due for them to pay back. They all have an underlier. They all have an underlying index, hence why we use the term market-linked index. What indices can they be used? Well, all the ones listed here, and they're pretty common, right? Market-linked indices. The S&P 500 is a market index. The Dow Jones is a market index. ETFs are market indices. You can pick, sections of the S&P 500, small, mid, different types of ETFs. Equities, individual stocks, commodities, oil, gold, palladium. You can pick all sorts of different commodities, and then currencies. They can be on the yen, or they can be on the euro. They can be on the U.S. versus some other currency. There are endless amounts of indices that are easily and widely available to be tracked, and anything that can be easily tracked as a market index could be one of the underliers on a market-linked investment. The other thing they all have in common is they all mature. There's a couple of different ways in which they mature. So they either have a set term, and when does that happen? Well, that's determined before the issuance, or they have an early call provision, and sometimes they call us early. What they do is then they pay a kicker. They pay there is an enticing payment that has to be made because of the fact they're calling it early. Protection features. So before I talked about capital preservation, there are really 4 different types of protections. One, full protection. So before I talked about market-linked CDs or sometimes just credit-backed market-linked notes. That's when 100% of the risk of the downside is taken by the issuer, right? You're guaranteed either by the FDIC or by the issuer, most of the time by the issuer, to return your money at the end of the period, no matter what happens with the underlying index. The next 2 are very similar, so I like to compare and contrast them. Partial and contingent. Really, the words we use are hard buffers and barriers. And how do they work? Hard buffer, right, is there on this side. And this has a protection level, and you can pick whatever the protection level is. Let's say the protection level in this instance was 15%. From the initial level, the day at which the note closed and then set its observation level, the protection level then is how much does the market decline from there. So if the protection level is 15% and the market's only down 10%, we get 100% of our principal back with a hard buffer. If it's down below that, let's say it's down 20%, right? That section is on us. So now, if the market's down 20%, the buffer of 15%, we're only down 5%. So we've now outperformed the market on the downside. Additionally, a barrier, what is a barrier? A barrier works the same way with limited downside. Usually barriers are deeper than the equivalent buffer would be. So let's use the number 25%. Again, if it's below the barrier or the protection level for the decline, you get 100% of your money back. However, with a barrier note, what's very important to know is as this declines and it goes past that protection level, we now get the same returns as the broader index. And the last type of protection is no underlying protection at all. And there are different reasons why you might do that for different notes, but that is a possibility as well. So each note should be evaluated on its own for its own merits. And the last one is payments. So they pay out based on an index. 1, market participation. So how does this work? If the market grows, we can get paid back either as a multiple of the performance. 0.75 would mean 7.5% of the overall, or 7.5 times the overall growth. So if you think about this logically, it'd be like if the market went up 10, you'd only be up 7.5. 1 is equivalent. So if the market's up 10, you're also up 10. 1.8 is an accelerated return. So if the market's up 10, we're up 18. If the market's up 20, we're up 36. It's an accelerated for the underlier. The next one is a fixed payment. So we know what the fixed payment is going to be at the end, as long as it's above the initial level. Normally they'll set a rate for that period. And the last one is periodic coupons. We'll get either quarterly or semi-annual payments throughout the entirety. Key 5 terms, right? The type, what they're linked to, the length of maturity, the different protections, and then how does it pay out at the end. And stay with me for just a minute, because I know this can be a little bit complicated, but as I go through the examples, I think that's where this really shines. A couple other key things to take into consideration. Creditworthiness. That company you lend to has to be around to pay you back at the end. That's why we try to make sure we have issuers different timelines. Liquidity. When we buy these things, they do have a liquid market, but it is not as liquid as, say, stocks or bonds. So there is an illiquidity premium that is paid if we want to get out of these early. Because of that, we want to make sure that people's timelines line up with their liquidity needs. So when we buy these, typically we have no plan to sell them until they get called away or mature. Understanding the performance, it's important to understand the risks associated. The fees, there are different fee structures. We can do them either in commission or fee-based accounts, depending on what we think is best for clients. And then tax treatments. Taxes are usually very advantageous, but it's important to understand those as well. This is a reminder of those risks. And I guess before I get to the examples, how are these things created? So structured investments are created basically because the research team thinks they're a great idea. They want to take advantage of something they see in the market. So what do? They use the research, they develop an idea, they go out to multiple different issuers and ask them if they want to participate. And then every month we get several dozen or so different structured notes with some of the best ideas tied to them that are priced against different issuers. And actually, because of our affiliation with Steward Partners, we actually have more than just this desk, so we actually get even more possible structured notes that we analyze every month and they consistently open and close. And usually we get very similar notes month to month, but no two are ever exactly the same. Some definitions. I'm going to slow roll this so that people that are watching this later can look at it and read them. I think most of these definitions people are familiar with, but if not, they can replay that later. Examples. This is where I think this is most important. So what's going to be key on all of these slides is these gray boxes. They're going to tell you everything you need to know. So what is the first type of note? Well, this is, I think, the most simplistic one. It's a market participation barrier protection note. It's a complicated thing to say, but it's easier to understand. It's tied to the S&P 500. That's the index. I think everybody's familiar with that one. The term is 5 years. So 5 years from the initial date of entry. 100% protected from the issuer. So whatever issuer would issue a note like this, we're hoping they're around in 5 years to pay us back. And at the end of that period, what happens? We're going to get paid the same as the S&P, up to a cap of 35%. So let's break that down. What happens in really the three scenarios that are going to play out? Once this is bought 5 years later, at the end of the note, only one of three things has happened. Scenario 3, the market's down 22. What happens? We get all of our principal back. All right, so we didn't lose any money. So why would we buy this? Well, right there, if we think the market's going to take a huge loss, and we're scared of, it's great to lock in that level. And when the market goes down, not lose any money. Scenario 2, the market goes up slightly. Well, we're going to match the market. So in this case, it said 27. We'll be up 27 as well. We match the market performance. So we didn't get to lose out on that. And then lastly is scenario 1. The market goes up a lot, goes up 40%. We capped out at 35%. And so again, why would we buy this note? If we think the market is relatively hot or it's overheated, this allows us to still participate if we're wrong, but also gives us some protections if we turn out to be right. The next example is the only one I'm going to talk about that's a market-linked CD. This one has the FDIC insurance. And I'm going to sort of cut by this a little bit quickly. All the terms in these gray boxes are almost the same as the previous slide. The difference is FDIC insurance instead of the creditor, and the max cap is now 30 instead of 35. And that's typically what you see with FDIC insured notes. They're typically just slightly less attractive terms, but we get the FDIC insurance in response. So what happens here? It's the exact same three scenarios, right? The market goes down a lot, we get all of our money back, but FDIC insured. The market goes up slightly, we match the market. The market goes up a lot, we don't participate completely, but we do still make money on the upside. Buffered notes. So this one's a little bit different. This has got better upside terms and slightly. There's constantly trade-offs. Again, we're going to tie this one to the S&P 500. This one's only going to be 4 years. It's going to have a 20% buffer and 1.2 times the return to a max cap of 50. So what does that look like? How does it play out? Well, the market goes down a lot. Right? The market goes down 27%. So the S&P is down 27% of that 4-year period. We're down 7. So the market's gotten absolutely crushed, and we're actually not down nearly as much. Scenario 3, the market's down 15%. Still a very ugly market, but we're not down anything. We get all of our principal back. On the upside, the market's up 30. Well, we get 1.2 times. So if the market's up 30 times 1.2, we get 36% return. We've actually outperformed the market on the upside. And then in the last one, the market is way up. It goes up beyond the 50% cap. It goes up 60%. We are capped out at 50. So we get a lot of upside participation. We get more protection. But really, we're taking a hedged bet on where we think the market's going to go. And that's one of the reasons these things are disintermediating hedge funds. They're more attractive. They're easier to understand. And we can buy them in much, much smaller pieces. We don't have to give them $500,000 in the liquidity lockups. We can do this for relatively small amounts of dollars. And we can buy multiples of them. The next example is a barrier note. So we just talked about buffers. Now we're going to talk about barriers. This one's tied to the Dow. Again, another very familiar index. It's 3 years, 25% contingent barrier. So the barrier is a little bit steeper. Participation rate is 1.5 times and a market cap return of 40%. So how does this play out? Well, again, we've only got a couple of scenarios to look at. Scenario 1, the market's down 31. We match the market over that period. So if you were thinking, hey, I might put money into the Dow Jones Industrial period and probably keep it there for 3 years, well, this isn't the worst note to buy because In either case, you're going to be down about the same amount of money. However, if we're down less than our protection level of 25%, we're down 12, we get all of our money back. So we're actually better off in that scenario. The upside, we get 1.5 times. So if the market's up 20, we're up 30. So 20 times 1.5, we're up 30%. And then, of course, there's an upside cap, again, of 40%. So if the market goes way up, we don't fully participate. But again, we got protections, and we had a much better chance to make money in sort of more moderate returning markets. Digital notes. These are very, very interesting. S&P 500, 6 years, 30% barrier. The 45% payment comes into place when the underlier is above its initial level. And that's it. After that, we get 1 times the uncapped underlier above 45%. Put that in very simplistic terms, what it means is when the market goes up even just a penny after 6 years, we get 45% return. And if the market goes way up, so scenario 1, the market goes way up, we forget about the 45% and we start to match the market. So if the market's up 62, we're up 62. If the market's only up 1, or in this case it says 28, we're up 45. The market's down 15, we've got a barrier protection of 30%. We're not down anything. In scenario 4, the market's down 38, we are down 38. Right? So we're down the same downside risk over that period of time. Autocallable notes, these are ones that we use when people are asking us more about income. This is tied to 2 different indices, the S&P 500 and the Russell 2000. This is 4 years, has a 30% contingent, and 9% per year if it's called. Well, there's a couple of different things that might happen. After 1 year on the observation date, 1 year, the anniversary from when we originally bought it, we're going to look and say, is the market up? If the market's up, note's going to get called away. It's going to be done. We're going to make 9%. If it's not up, right, it's not going to be called. So it continues on for another year. So in year 2, we're going to take another look. And instead of 9% in year 2, if the market's up, we're going to make 18. But if the market's still not up on that observation date, it continues to year 3. And on that date, and if the market's up, it'll be up 27%. So we keep making, 9% for each year. At the end of 4 years, either the market's going to be up and we're going to make the total amount, right? We're going to get the 9% times the 4 years, or we're going to have our barrier come into place. So if the market's down less than 30, we'll get our principal back. And then the last case scenario is if the market is really down 4 years in a row and it's never been called any of the previous 4 years, so it's, it had to miss all the other anniversary dates. On that 4th anniversary date, we are going to get the return of the lesser of the 2 indices. Coupons. So again, we're tying it to 2 different underliers. And why do we tie it to 2 different underliers? Usually gives us better terms. So it's something to keep in mind. But this one's for 5 years. It's another contingent barrier. And this one pays us 6.2% paid semi-annually. So we get 3.1% every 6 months. As long as the market is above that 30% initial level. So how does this work? Every single 6 months, it takes a look and says, are we above 30% from where, are we above 70% of where we started? Or not down more than 30? If we're not, we get paid the whole time. And if we are at any point below, we miss that coupon payment. And then if it rises back, we start getting the coupon payment again. And again, the final terms work very similar to before. We're either going to keep getting the coupon, right? Or we're going to have that barrier come into place, and we're either going to be down very, very much if it's been a horrible market for that 5-year term, or we're going to make the coupon at the end. So I know I ran through a number of examples, and I hope I wasn't going too fast, but the key thing here is that there are a lot of different ways to use these tools. And some of them are definitely protection-oriented, some of them are definitely growth-oriented, and it depends because right at the time and the terms that are available to us. Right now, the terms have been extremely generous to us, so we want to keep using these. But our final thoughts before we're leaving, structured investments, why do we use these? Well, a couple of years ago, everybody was asking me, what can I buy except stocks and bonds? Well, this is a great answer because they're not quite stocks, they're not quite bonds. There's a little bit of correlation, but they do offer a diversification. Second thing is illiquidity. As great as they've worked out for some people, we can't put 100% in there. We want to make sure we have different issuers. We want to make sure that we have different maturities. We do want to make sure that we hold the investment to maturity. So when we buy these things, we have something called intrinsic and something called market value. Whenever we buy these things and we have to wait 5 years, typically get discounted early on, and only at the observation date or the final maturity date do we realize the full amount of that term. In between there and then, the market can offer us whatever they want to buy these from us. And the way I like to think about it, it's sort of like driving a car off a lot. We all know it goes down in value after you do that, but we don't sell it to the guy in the next corner who offers us a 10% discount off the car we just purchased. They're not really available at that price. So what happens is eventually when we sell, that's the final number that we realize. And the last thing is laddering. We want to be very considerate of that. If you pick a pretty nasty date in history, March of 2020, you don't want every single note that you have coming due that same month, right? So you want them over multiple maturities, multiple different timelines, and you want multiple different indices, multiple backers to build out that entire structured note portfolio. With that, I want to thank everybody for joining us. If people have follow-up questions, I'm happy to answer them. For us, structured notes, again, they're about optimizing your wealth. They're introducing new tools to people they're not quite aware of, and utilizing tools on a daily basis that most people have never seen, never heard of. With that, I want to thank everybody for joining me today, and hopefully we'll hear from you soon. Thanks.